Look around. For years, the media and the corporate elites sold you a shiny, silent, lithium-powered utopia. They told you the internal combustion engine was a fossil, literally and metaphorically. They gaslighted you into believing that if you didn't have a plug in your garage by 2025, you were a dinosaur waiting for the asteroid. But hold up, that's a massive lie. While you were busy dreaming of a zero-emission future and checking out those minimalist dashboards, the world's biggest automakers just lit $100 billion on fire. This isn't just a pivot, it's a full-blown retreat. Ford is literally turning those billion-dollar EV plants back into gas truck factories because, shocker, people actually want to drive more than 200 miles without a 3-hour coffee break. GM is taking a $50 billion L on its entire electric strategy. And the federal government just pulled the plug on the only thing keeping this industry alive, the tax credits. The era of cheap subsidized virtue signaling is over. It's not a transition. It's a controlled demolition of a Silicon Valley fantasy. You've been sold a dream that the grid couldn't handle and your wallet couldn't afford. Ready to shift? Let's dive into the mechanism of the great EV pullback. Imagine spending $5 billion on a kitchen designed only to cook tofu. You have the specialized pans, the perfect steaming racks, and a whole staff trained in the fine art of bean curd. But then, on the day you open your doors, the entire world suddenly decides they only want to eat steak. That's not just a bad business day. That's the stranded capital problem. It's the ultimate skill issue for the giants of Detroit and Seoul. Automakers like Ford and Hyundai didn't just walk into the electric vehicle market. They sprinted. They tripped over themselves to announce megaplants and battery gigafactories, desperate to prove to Wall Street that they weren't just old-school metal bangers. But here's the cold reality. When consumer demand hit a brick wall in late 2024 and 2025, those shiny new assets didn't become the future. They became anchors. Let's talk about Ford for a second. They poured billions into their Tennessee electric truck campus. They called it the future of American manufacturing. But as the losses started stacking up to the tune of $5 billion a year in their electric division, they had to do the corporate walk of shame. They are literally pulling back and trying to figure out how to put gas engines back into these plants. If you think that is easy, you've never seen a production line. It's like trying to turn a toaster into a microwave while the toast is still inside. Then you have Hyundai. They built this massive meta plant in Georgia promising a pure electric revolution. They got the tax breaks, they got the headlines, but the moment the market cooled down, they scrambled to add hybrid production lines to a factory that was never supposed to smell like gasoline. It is a desperate, messy pivot. They're calling it strategic flexibility, but in plain English, it's a frantic attempt to stop the bleeding. The financial term for this is a non-cash write-down, which is just corporate speak. For we messed up the math so badly that this billion-dollar building is now worth significantly less than the dirt it's sitting on. GM is looking at a potential $53 billion write-off risk, $53 billion. That is not a rounding error. That's the entire market cap of some major companies just evaporating because they bet on a narrative instead of the numbers. And let's not even get started on the startups like Rivian or Lucid. These guys are the ultimate bag holders. Rivian lost around $36,000 on every single vehicle they delivered in early 2025. Can you imagine that? Every time someone buys one of their trucks, the company writes a check for $36,000 to the void. That's not a business model. That's a slow-motion car crash funded by venture capital copium. Investors were told that the transition was inevitable, that the internal combustion engine was dead. But the legacy automakers are now desperately crawling back to the high-margin gas guzzlers that actually pay the bills. The F-150 and the Silverado aren't just trucks anymore. They're the life support machines for the entire industry. Every time a big V8 engine rolls off the line, an executive in Detroit gets to keep their job for another week while they try to hide the $100 billion hole in their balance sheet. You see, the system was rigged on the assumption that you, the consumer, would just accept a more expensive, less convenient product because it was the right thing to do. But capital doesn't care about the right thing. It cares about the return. And when the return on electric vehicles went negative, the dream died. Now we're left with these massive empty monuments to corporate ego. They are the new rust belt in the making, and the shift back to gas is the only way these companies survive the decade. It's a classic case of exit liquidity. The early adopters and the green energy funds got their hype, but the average Joe is the one left holding the bag, as these companies realize they can't force a revolution that the infrastructure can't support. The gear has shifted, but it didn't shift into the future. It shifted into reverse. Let's get one thing straight. The electric vehicle market in the United States was never built on consumer love or some sudden awakening of environmental consciousness. It was built on a massive, federally funded life support system. It was an industry on government steroids. For years, the Inflation Reduction Act tax credits were the training wheels that kept this shaky bicycle from toppling over. But the moment those wheels came off in late 2025, the entire industry didn't just wobble. It fell off a literal cliff. We're talking about a policy whiplash so severe it gave the entire Detroit boardrooms a permanent case of vertigo. Think about the numbers. In early 2025, the electric vehicle market share was peaking at around 12%. It felt like the momentum was unstoppable. But then the political winds shifted. The federal government decided they were tired of subsidizing toys for the wealthy and pulled the plug on the $7,500 tax credit. The result? Sales didn't just slow down, they plummeted. That 12% market share dropped to under 6% faster than a Tesla in ludicrous mode. This is what we call a classic skill issue for the legacy automakers. If your entire business model depends on the taxpayer giving your customer a $7,500 bribe just to consider your product, you don't have a product. You have a welfare program on wheels. It is a fundamental failure of capitalism when a multi-billion-dollar corporation cannot build a profitable machine without Uncle Sam holding their hand every step of the way. The Harvard Salata Institute recently pointed out that removing these credits would save the Treasury around $168.5 billion over 10 years. That's $168 billion that was being used to prop up an artificial market. When that money vanished, the reality set in. For the average American, the math simply doesn't check out anymore. Why would you pay a 30% premium for a vehicle that has less range, slower refueling, and depreciates faster than a gallon of milk in the sun? Especially when the government isn't there to pay the down payment for you. The automakers are now dealing with a massive addiction problem. They are addicted to the subsidies. They built their entire 2030 strategy around the assumption that the government would keep the printers running forever. But the taxpayers eventually grew tired of the gaslighting. They were told that electric vehicles would be cheaper to own, but then insurance premiums skyrocketed because one small fender bender can total a lithium battery pack. They were told the infrastructure would be there, but the national charging network remains a fragmented, broken joke. The policy whiplash isn't just about the money, though. It's about the trust. When the government changes the rules of the game every 4 years, nobody wins. Investors hate uncertainty, and right now, the electric vehicle sector is the definition of a red flag. We saw sales fall off a cliff because the demand was pulled forward. Everyone who wanted an electric vehicle and could afford one already bought one while the credits were active. Now, the companies are staring at the remaining 90% of the population who are looking at these cars and saying, "No thanks, I'll keep my gas tank." It's an L ratio of epic proportions for the policymakers in Washington. They tried to force a technological revolution through legislation instead of innovation. You can't just pass a law and expect the laws of physics and economics to bend to your will. The market is now correcting itself with a vengeance. The companies that bet everything on the green wave are now drowning in a sea of red ink. They are begging for a mulligan, a do-over, anything to stop the bleeding. But here's the hot take. This collapse was necessary. It's the only way to expose the rot. We're seeing which companies actually know how to build a car and which ones were just playing a high-stakes game of regulatory arbitrage. The era of the electric vehicle being a protected species is over. From now on, they have to fight for their lives on a level playing field, and without their $7,500 crutch, most of them are finding out they can't even stand up. While every tech bro on Twitter and every suit in a boardroom was hyping pure battery electric vehicles as the only way forward, one company stood back and played the long game, Toyota. And let's be honest, everyone laughed at them. The media called them laggards. The environmental purists said they were sabotaging the future. They were mocked for clinging to their boomer tech while Tesla was supposedly changing the world. But who's laughing now? The silence from the EV camp is deafening because Toyota just pulled off the greatest I told you so in industrial history. Hybrid sales are up 30%, while electric vehicle inventory is literally rotting on dealer lots. This isn't just a minor trend shift. It's an L ratio for the EV-only purists that will be studied in business schools for decades. The market is screaming for a compromise, and the industry is finally being forced to listen. You see, the American dream of driving coast to coast on pure electrons was always a bit of a stretch for the average person. But the American reality of a 40-mile-per-gallon hybrid that actually works when it is 10 degrees below zero, the infrastructure in the United States is still, quite frankly, a joke. We've spent billions of taxpayer dollars, yet the experience of trying to find a working fast charger in the middle of a road trip is still like playing a high-stakes game of Russian roulette. You roll up to a station with 5% battery, and oops, 3 of the 4 chargers are out of service and the 4th one is charging at the speed of a dial-up modem. This is what we call a skill issue for the charging networks. They focused on the shiny tech and forgot about the actual service. Then came the great winter of 2024 and 2025. We saw the viral videos of the Tesla graveyards in Chicago. People were literally abandoning their $60,000 cars because the charging ports froze or the batteries couldn't hold enough juice to even warm up the cabin. That was the moment the bubble finally popped for a lot of people. They realized that a vehicle that requires a perfect laboratory environment to function isn't a vehicle. It's a luxury hobby. This is why the hybrid is the ultimate counter-revolution. It provides the fuel efficiency people want without the range anxiety that keeps them up at night. It's the bridge that the automakers tried to skip, and now they're paying a massive price for that arrogance. Ford, who once swore they were going all in on electric, is now pivoting their entire strategy to include hybrids across their entire lineup. Even GM, the company that famously killed the Chevy Volt and said they were committed to an all-electric future, is now crawling back to plug-in hybrids. It's a complete flip-flop that would make a politician blush. But why is building a hybrid so hard? Because it's actually more complex than a pure electric vehicle. You have to manage two different powertrains and make them talk to each other perfectly. This is where Toyota's decades of experience became their ultimate weapon. While everyone else was trying to figure out how to stack enough lithium to go 300 miles, Toyota was perfecting the art of efficiency. They didn't fall for the gaslighting that said the internal combustion engine was dead. They knew that a small battery and a high-efficiency engine was the most rational solution for 99% of the population. And look at the numbers. A typical hybrid uses about 1/10 the amount of precious minerals compared to a long-range electric vehicle. From a resource perspective, you could build 10 hybrids and save 10 times the carbon compared to one massive electric SUV that mostly sits in a driveway. But the narrative wasn't about logic, it was about the hype. Now that the hype has evaporated, we're left with the cold, hard math. Consumers have realized that they don't want to be early adopters for a technology that still feels like a beta test. They want reliability. They want a car that they can fill up in 5 minutes and drive for 500 miles. The hybrid offers exactly that with a lower price tag and better resale value. The dealers are begging for more hybrids because they can't keep them on the lot for more than 48 hours. Meanwhile, they're offering $5,000 discounts on electric vehicles just to get people to look at them, and it's still not working. This is a classic case of the market correcting a government-mandated delusion. You can push a narrative as hard as you want, you can subsidize it with billions of dollars, but at the end of the day, the consumer is king. And right now, the king is choosing the hybrid. The shift back to gas and electric synergy is the final nail in the coffin for the pure EV dream as a mass market reality in the 2020s. It's a reality check that has cost the industry $100 billion, and the lesson is clear. Don't bet against practicality. The hybrid isn't just a transition technology anymore, it is the winner of the car wars. The automakers are now desperately trying to rebrand their hybrid push as part of a multi-pathway approach. That's just a fancy way of saying we messed up and we need to make money again. They are adding hybrid options to their most popular trucks and SUVs because they know that's the only way to meet emission standards without going bankrupt. It's a retreat, plain and simple. The revolution was televised, but the counter-revolution is the one that's actually making the sales. The cold reality is that the system was never ready, and the math never checked out. We are witnessing a historic moment where the arrogance of the corporate elite meets the immovable wall of physical reality and consumer choice. But don't think for a second that these automakers are going to take their L in silence. Right now, they are begging for a mulligan, a total do-over. They are desperately trying to pivot the narrative because they need to distract you from the $100 billion hole they just burned in their collective balance sheets. Have you noticed how the conversation has suddenly shifted? All those CEOs who were screaming about electrification just 2 years ago are now suddenly obsessed with artificial intelligence and robotics. It is a classic smokescreen. Tesla is talking about humanoid robots and autonomous taxis instead of making the affordable Model 2 they promised. Ford and GM are dumping billions into software-defined vehicles. This is what we call corporate gaslighting at the highest level. They want you to look at the shiny AI tech demos so you won't look at the empty EV assembly lines and the mounting piles of unsold inventory. It is the same playbook they used for the EV dream. They sell you a futuristic promise that is always 5 years away, while they use your tax dollars and investment capital to stay afloat today. The AI pivot is just the new version of the EV hype cycle. They need a new buzzword to keep their stock prices from cratering while they figure out how to pay for the massive failure of their 2030 targets. It is a shell game played with your retirement funds. Let's talk about the energy grid, the inconvenient truth that everyone in Silicon Valley likes to ignore. Even if every single person in America wanted an electric vehicle tomorrow, the grid would snap like a dry twig. We haven't built significant nuclear capacity in decades, and our transformers are aging faster than the legacy automakers' business models. The irony is delicious. They are pivoting to AI, which consumes more power than almost any other technology in history, while the grid is already struggling to handle a few million plug-in cars. It is a paradox built on a foundation of pure hopium. And what about the workers? The people in states like Tennessee and Georgia who were told that these mega plants were their ticket to the future. They are the ones who will pay the ultimate price for this strategic failure. When a factory shifts from pure electric back to gas or hybrid, it is not just a change in machinery. It is a loss of trust. The billions of dollars in state and federal incentives that were used to build these monuments to ego could have been used to actually fix the crumbling roads or update the power grid. Instead, it was used to subsidize a product that the market didn't want and the infrastructure couldn't support. This is a skill issue of a global scale. While Detroit and Europe were busy patting themselves on the back for their green commitments, China was quietly securing the entire supply chain. They realized that the transition wasn't about the cars, it was about the minerals. Now, the West is trapped between a rock and a hard place. They can't compete with Chinese prices, so they hide behind tariffs and protectionism. But protectionism is just a slow death for innovation. It's like putting a bandage on a gunshot wound and calling it a recovery. If you are an investor or a consumer, you need to wake up. Stop being the exit liquidity for these corporate fantasies. The EV dream isn't dead, but it is going into a long, cold coma. It will eventually return, but only when the technology is actually ready and the economics make sense without government steroids. Until then, gas and hybrids are going to keep the lights on and the wheels turning. The legacy automakers are now in a survival race. They have to find a way to pay off the massive debt they incurred building these stranded assets while competing with nimble competitors and a skeptical public. Expect to see more non-cash write-downs. Expect to see more quiet layoffs and project cancellations. They will try to rebrand it as streamlining or efficiency, but you know the truth. It is a retreat. We are moving into an era of realism. The era of the shiny tech demo and the 5-year promise is over. People want products that work today, not ideas that might work in 2030. The hybrid is the king of the road because it respects the consumer's time and money. The electric vehicle is a great second car for a wealthy family with a garage, but it is not yet the primary vehicle for the working class. Ignoring that reality was the biggest mistake Detroit ever made. So what is the lesson here? The lesson is that you cannot force a market through sheer willpower and taxpayer money. You cannot ignore the laws of physics and the reality of the supply chain. The great EV pullback is a warning to every other industry that is currently drunk on the wine of government subsidies and hype. Eventually, the bill comes due. And that bill is currently sitting at $100 billion and counting. Don't let them gaslight you into thinking this was all part of the plan. It wasn't. They messed up the math, they misread the room, and now they are trying to hide the evidence. Stay sharp. Don't fall for the next shiny thing they dangle in front of you. Whether it is a humanoid robot or an AI-powered toaster, ask yourself if the math checks out. Because in the end, the math is the only thing that matters in the gear shift of global capital. The industry is in a state of chaos, but chaos is a ladder for those who are paying attention. The companies that survive this will be the ones that stop chasing the narrative and start chasing the return. The ones that realize that a car is a tool, not a political statement. The era of virtue signaling on wheels is coming to an end, and the era of the practical, efficient machine is back. That's it for today. Stay sharp and keep shifting. You know the drill. Like and subscribe.